think Indian market, if you ask me, is largely driven by earnings growth, right? So if you historically look at Indian stock market returns have always mirrored earnings growth, and Indian dependency on export revenues has always been fair lesser, right? So the large part of the revenue or the earnings growth for Indian companies come from domestic revenues, and export continues to remain very small. Having said that, if global markets go into a bit of a negative spiral that we are seeing recently, some of the export businesses like IT can get impacted in the near term. But we do believe that with the advent of AI coming back, some of the Indian IT still continues to remain in a very good shape for the longer term. So I don't see a material impact on Indian markets if global markets go into a bit of a negative spiral, given the fundamentals of the Indian economy and fundamentals of the earnings growth as far as India is concerned.
And there's not too much yen-funded liquidity fueling the Indian market?
Not really. I don't think that's a very large number for Indian market per se. But yes, obviously, if global markets go into a bit of a negative spiral, it does have a rub-off impact on India. India in the last 4 years hasn't seen one more than 15% drawdown. It's been a 4 year of bull market. And definitely in such large bull market, you definitely do see some small corrections coming on the way. But I don't think the longer-term bull market of India is impacted at all. So we've just started, and this decade definitely belongs to India.
Okay, so then what do you continue to buy in India at a time like this?
So I think 3-4 sectors. We've also moved our allocation to more defensive. So we've been overweight on telecom in the last 2-3 quarters, and telecom has done extremely well for us. We also are now looking at IT. Obviously, with global slowdown, IT does get impacted. We definitely believe that's a great opportunity to look at IT because IT does bounce back very strongly, once the cycle kind of comes back. And the third that we continue to like is consumer discretionary in India. A lot of the food delivery startups in India continue to grow at more than 50-60%. And I think the runway of growth for some of these consumer discretionary names is very high, given the wealth effect that we are seeing in the economy. So I think these are the 3 major sectors where we continue to remain overweight.
What would you avoid in the market?
So I think we would definitely go and avoid some of the PSU sectors. Banking is something that we've been underweight for last 1 year, and we believe there's another 1 year of underperformance likely for the banking sector. And metals, auto, and cement is something that we continue to remain underweight on.
I do want to get your sense on, Niket, the bond markets, because we're seeing a massive bond rally across the world. And if we can bring up the Indian benchmark bond, in anticipation, of course, of rate cuts. And if that happens, then do you think the RBI will also look at lowering rates being less restrictive? Actually, right now, the narrative is being less restrictive. So do you think that the RBI will go that way? And so Indian bonds look favorable from that extent? Because look at the yields on each of the durations. 6.5% is quite compelling, quite attractive.
That's true, Tanveer. So I think we definitely believe that interest rate has to get cut, not only in US, but in India as well. Inflation has remained broadly under control, and I think RBI has done a phenomenal job, if I have to compare with some of the global markets, to ensure that inflation has been controlled, specifically on food and non-food side, both of them. Our sense is that RBI will definitely cut rates once US rate cut starts. And we definitely believe that there should be at least a 50 to 75 basis point rate cut in the next 12 months at least.